welcome back to my channel. Today's video is all about gamma exposure. So in the first half, I'll explain how it functions, I'll provide an example using SPX, and I'll end the video with a resource that can be used to evaluate the numbers. So let's dive right into it. So gamma exposure is commonly referred to as GEX, and basically what it does is measures the potential market impact caused by options institutional investors adjusting their positions as a stock moves up and down. And the reason the GEX is so important is that it's an element used heavily in options trading to understand how price action might accelerate or decelerate based upon positioning. So you may not see it on your broker dashboard, but it plays a significant role when we talk about price action. The GEX is one of the main factors that dictates it. So primarily, understanding the gamma exposure will help you learn how to refrain from chasing the price and understand what's the driving force behind the price. So to break it down, let's start with the option Greeks. The delta measures how much an option's price will change for every $1 move in the underlying asset. The gamma measures how much delta will change for every $1 move in the stock. So higher gamma means delta is more sensitive to price changes, making gamma essential in understanding how an option's exposure shifts as the market moves. Now, one important thing to note is that the GEX is not a theoretical number. It actually reflects a real demand for buying or selling the stock as the price moves. And if you know how to accurately read it, it can tell you how intraday prices will change throughout the trading day. Now let's go ahead and discuss the market maker hedging and the gamma exposure to explain it in more detail. So market makers are also known as institutional investors. So you'll hear me use those words interchangeably. So these market makers are usually on the side of the trade when retail traders buy options. To avoid taking on directional risk, they stay what's known as delta neutral, which means that they hedge by trading stocks to balance out their exposure. When a market maker sells a call option, they might buy shares of the stock to offset the potential losses if the price soars. As the stock rises and the option's delta increases, they'll continue buying more shares to stay hedged. But on the other hand, if the stock falls and delta drops, they'll reduce their position by selling shares to remain neutral. So what I mean by this is that this constant hedging activity up and down, it causes the market makers to actively participate in price movements, especially when options with large open interest are in play. So to understand the GEX, it's imperative to know that there is positive and negative gamma. So when there's positive gamma, market makers go long on gamma, often through those hedge positions as mentioned. Their hedging leads them to buy as prices go down and sell as prices go up. This can add momentum to trending moves and suppress volatility because they make money if the price stabilizes, so it's a way to hedge mean reversion. Now, I can mention one little known secret is that this often happens when calls are heavily sold to open, especially above the current price, meaning out the money. One example of this is if you see SPY sitting flat despite all the bullish or bearish news, that's probably a high GEX zone, more than likely. Now with negative gamma, think of high volatility. When big investors are short on gamma, it flips. They're forced to sell into drops and buy into rallies, which often leads to sharp price reversals and exaggerated swings in the market because they lose when the price moves away from their position. So they naturally hedge with the move. So the result of this is that when moves get real sharp, fake outs tend to become shakeouts. And this is specifically because of the increased put buying below current price. And I made a dedicated video on the PCR, so I'll leave a link to it down below because all of this ties in together. So for the same example, if SPY declines and it maintains the sell-off even after reaching oversold RSI levels, GEX is negative and volatility has no break. So if someone is a momentum trader, they tend to favor a high negative GEX because it presents the opportunity for quick scalps, and it makes perfect sense because the volatility is on their side. Now, this dynamic between delta hedging and gamma exposure is a key factor behind setting price moves of volatility zones and identifying gamma walls, especially around key strike prices and during options expiration weeks, so just keep that in the forefront. So let's talk more about this in a little bit more detail. Okay, how gamma exposure shapes price action. So essentially when gamma exposure is elevated, especially as options expiration approaches, it can dramatically influence how the market behaves. So in reference to positive zones, if there's strong positive gamma around key strikes, price movement tends to slow down. That's because the market makers are hedging in a way that absorbs the volatility, creating a stabilizing effect. If GEX is high at a certain price, that level becomes a magnet or resistance depending on the direction. It's like the invisible gravity of the options world. So you want to ideally check the GEX level by strike price. Now, negative zones on the flip side offer heavy negative gamma that can fuel rapid and uncertain price swings. And institutional investors have to hedge more aggressively, which can drive prices even further in the direction of the move. Now, the reason why traders track gamma exposure is one going to be the volatility forecasting. So you can monitor gamma levels to help anticipate when the market might stay range bound versus when it's primed for big swings. It also helps to identify strike pinning. And this is when high gamma gathers around a certain strike price and the stock often gravitates towards that level near expiration. And this is the behavior known as quote unquote the pinning. So it's kind of like attracted to it, so think of it in that way. Now, it's also important to take into account what's known as a gamma squeeze setup. So let's say that the price pushes through a key level with a lot of open interest. Market makers may be forced to keep buying or selling at an accelerated pace, and this can create a feedback rotation that forces the stock into sharp, fast moves, which is what traders call a gamma squeeze. Now, I know this is a lot of information, but tapping into gamma data can give traders an edge. It's not just about spotting potential moves, but in understanding why the market's reacting the way it is. So GEX is a pretty powerful concept, especially when options are heavily traded. Understanding where large gamma positions exist can provide valuable knowledge into how big investors might respond and how that could impact how the price moves on a large scale. So most times I combine gamma exposure with technical analysis and volume data just to identify potential trade setups. All right, so now that we have this understanding, let's break down a gamma exposure example using SPX to see a realistic way that this typically plays out. Okay, so for this scenario setup, we're going to say that SPX current price is $5,000. We'll set the call option strike to $5,050 and the put option strike to $4,950. We'll also say that it's nearing the expiration for a Friday. So the market maker's role is to short both calls and puts, meaning they have negative gamma and need to hedge their exposure. So looking at the delta in gamma values, at $5,000 for SPX, let's say the call option delta is at a 0.3, and let's say the put option delta is at a negative 0.3. And in this case, we'll keep the call gamma at a 0.02 and the put gamma at a 0.02 as well. So institutional investors will hedge by buying shares when they see calls and selling shares when they see puts to remain at neutrality. So with this example in mind, if the market moves up and SPX rallies from $5,000 to $5,020, the call options delta increases from a 0.3 to a 0.4 due to gamma. The put options delta decreases from a negative 0.3 to a negative 0.2, and as a result, big investors must now buy more SPX shares to keep the delta at equilibrium. And the hedging impact of this is that the call delta changes from a 0.4 minus a 0.3 to equal a 0.1. The put delta change is at a negative 0.2 minus the negative 0.3, which also puts it at a 0.1. So the total delta increase in this case is at a 0.1 for calls plus the 0.1 for puts, which totals out to a 0.2. So that may be a bit confusing, so let me break it down. For every one SPX point move, market makers adjust by 0.2 SPX equivalent shares per option. So this is a real-life practical example, so let me show you how it will play out with the numbers. So for instance, in this example, if there are 50,000 option contracts, you would multiply the 50,000 times the 0.2 times the 5,020, and that would give you over $50 million worth of SPX buying pressure. This then creates a feedback rotation or loop. As SPX rises, big investors must keep buying more to stay delta neutral, driving SPX's prices higher. And this is what I mentioned before, which is called a gamma squeeze. Now to analyze the opposite, if the market moves down, now suppose SPX drops from $5,000 to $4,980. The call options delta drops to a 0.2. The put options delta increases to a negative 0.4, and market makers now needing to reduce their hedge, they start to sell SPX shares. So the selling impact of this is that the call delta changed from a 0.2 minus a 0.3, which gives us a negative 0.1. The put delta change is at a negative 0.4 minus a negative 0.3, which places it at a negative 0.1. So in summation, the total delta decrease is the negative 0.1 plus the negative 0.1, which results in a negative 0.2. Again, this may be a little tough to follow, but I'll tie it all together, y'all, trust me. So keeping the same variables for this example, if there's 50,000 contracts, you multiply the 50,000 times the 0.2, and then multiply that by the 4,980, which then gives you $49.8 million in SPX selling pressure. Now keep in mind, this could accelerate the sell-off, further increasing volatility. So although this may seem like a complex calculation, it is very useful and beneficial. Okay, y'all, I know that's a lot of information, but the key takeaways from this example are that when gamma is positive, market makers hedging slows volatility. But on the other hand, when gamma is negative, market makers' actions amplify volatility, so it heightens it. Now, the best recommendation is to monitor gamma exposure to anticipate possible sharp price moves, especially around set DTE and when you're analyzing contracts with high open interest. So all in all, GEX is all about telling how aggressive the hedging is in the market because it explains a lot of the moves that catch many traders off guard. So just some free game. If you're watching SPX and see a gamma squeeze forming, recognizing these dynamics could offer opportunities for short-term trades. So I hope this all makes sense. But let's go ahead and dive into a resource to help tie all of this together to show how the GEX is analyzed visually using this data. So by the end of this video, hopefully you can understand how gamma positioning can give you a real-time advantage when anticipating gamma squeezes or sharp reversals. Okay, so the last thing I wanted to go over in this video is a free resource that you can utilize to analyze the GEX. And I'm currently on the website unusualwhales.com. This is not sponsored by them. However, I did want to provide this information for anyone who may be new to GEX and wondering where they can get this information. Since it's not readily available in Thinkorswim, you would have to actually use an outside source in order to gather and evaluate the GEX. So with that being said, all I did was go to the website. I clicked on Ticker Explorer here, and then I typed in SPX, and then of course this is the screen that popped up. Now, of course, I'm viewing this information from 2 days ago, simply because it is the weekend. But if you wanted to sign up for this site, you can definitely do so, and you'll unlock more of the features. You'll also be able to see things happening live as well for the updates. So the first thing you'll see here is under spot, it shows the exposure, and of course we're looking at the gamma. Then of course it shows us here a good breakdown as far as like a bar chart, and we can see the open interest here in purple, and then of course the volume is here in yellow. Now here on the y-axis, you see that this is where the strike prices are listed, and then here on the x-axis, you can see where the gamma exposure is listed. Now you don't have to view it from this direction. I will show you right here where it says directionalized volume. If you click this drop down, you can click on total volume and it'll show up here. And then you can also change the number of strikes as well. So if you wanted to look at maybe 30, 35, or 40, you can click any of those. And then you'll see here where it says bar for this drop down, you can actually have it set for column, and you can see it this way as well. It's totally your choice on how you choose to view it. I like to have it set for bar just because I have a preference to see it this way visually. And then I also like to keep the directionalized volume set as well. You'll also notice under info here, they're going to give you a very detailed description of everything. So they talk about the spot gamma here at the top. They then go ahead and talk about the directionalized way of viewing things. And then they also give you a full contextual breakdown on how to use this tool as well. So they talk about the long positions and the positive gamma. They also talk about the negative gamma. And these are the things I just covered in the video. But of course, you can take your time to read through this and kind of get more understanding. So I'll click close for now. Now you will see over here on the right side, it does say details, and it breaks down everything you see here on this bar chart. So for example, it shows us the ticker symbol, it shows us the date and time it was last updated, and then it also shows us the at the money strike. Underneath that, we see the open interest. It shows us the gamma per 1% price change. It then shows us the net gamma exposure. Under that, we see the volume with also showing the percent change and then the net gamma exposure. And then lastly, the directionalized volume with the percent change and then the net gamma exposure as well. Now, one of the things to keep in mind is, again, you want to pay attention to the at the money strike price because they have it leveled here in the middle. It's super important to make sure that you're keeping track of this and understanding how this is going to function. So I'm going to go ahead and scroll down so y'all can see underneath this. They also show us the live gamma exposure levels. And this chart is very sensitive. So if you wanted to kind of scroll it in and scroll it out, it will show you the information you're looking for. And they also have it broken down so you can take a look at the time frames. So let's say, for example, you didn't want to look at it on the 1 minute. They also have the weekly. You can do the monthly, 30-minute, 1 hour, 4 hour. Any of these would work. Now, clearly you don't see anything moving on the chart right now because the market isn't open, but again, you would see it as live updates if it were. So that is everything under this tab. I'm going to scroll back up and we're going to go ahead and take a look at gamma right here. If I click on this, the first thing you see at the top is it says that all data on this page is derived from open interest values and it was last updated on April 2nd. So now when we take a look at these bar charts here, and then they'll also give you a table on the right side. Same thing, it's going to show us the price here in yellow. And then, of course, the gamma is in purple. Now you can scroll this left to right and you'll be able to see as far back as December, I believe. Yes, that's correct. As far back as December, you can go ahead and take a look at this. If you also want to use it to incorporate in your back testing, that's a perfect way to go about strategizing a plan that you would want to develop. Or if you wanted to just see how this information played out and kind of get more familiar with it, this is a perfect way to do so because again, you can experiment with this in any way you see fit. So the main things to keep in mind are the gamma here. Of course, we're going to see the dates here at the bottom and then the prices set here on the right side. And then if you're more of the person that kind of likes to see the numbers broken down into an actual table, they have that as well. So you can see that here where it shows you the date, the call GEX, the put GEX, the net GEX, and then the PC GEX as well. And again, you can scroll down as far back as December to gather all of that information. Now underneath that, you're going to see where it says gamma exposure by strike. And of course, this is given a similar information as well. We see the put gamma in purple, we see the call gamma here in yellow, and then this fuchsia color here is showing us the net gamma. So scrolling down just a little bit, you'll see here, again, these are all going to be the strike prices here, and then at the bottom, you're going to see the gamma. Now the same information is super helpful here on this table. You're going to see the same thing broken down. They have it for the strike, the call GEX, put GEX, net GEX, and then the normalized GEX as well. So you can scroll down and see as much of this information as you need to, kind of retain the information and just learn how it works and how it functions. Underneath that, you're going to see where it says gamma exposure by expiry. Now this is extremely helpful as well because everything you would need is essentially lined up here on this specific chart. And then all of this information is clearly broken down here on this table. Same information, same rules apply. So lastly, you'll see underneath that, it's going to show you the largest GEC by strike and expiry. So if we take a look here, you'll see that they have the same information, but you're able to click on this drop down here and look at the expiration dates. So let's say, for example, you wanted to look at, let's say, April 3rd. Click on that, it'll pop that up. If you wanted to look on any date you see here, go ahead and click on it, gather that information, and again, use it for your evaluation. That way you can just improve your trading because the main thing to get out of this is just understanding how price action works, but more importantly, what is dictating price action. And the gamma exposure is one of the main things to do so, as mentioned. It's really just all about understanding how the money is flowing and then of course who is influencing how the money flows within the market. So I really hope all of this makes sense. So yeah, y'all, that'll pretty much do it for this video. If a more detailed breakdown is needed, I can definitely make another dedicated video on this topic. Y'all just let me know. So if you found this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.